Hey guys, how's it going? My name is Hamish Hodder and today we're going to be talking about the Walt Disney Company, Disney. And today we're going to start off by analyzing the business and looking at the four key areas that we look at, which is the economic moat, two, we look at how much debt a company has, three, we look at the ROIC, which is the return on investment capital, and lastly, we look at the four key growth numbers that determine whether or not this is a strong business going forward. Then I'm just going to spend a little bit talking about some of the future growth prospects for Disney over the next 5 or 10 years. And lastly, I'm going to value it. I'm going to put a value of how much I think Disney is worth and how much we should be willing to pay. And in that valuation, we're going to take into account the dividend that they've been paying for many years in a row. If you're new around here, we talk about investing, entrepreneurship, and personal finance topics all the time. So if you haven't already, make sure you subscribe so that you don't miss out on any of the great content coming out in the near future. We have a great playlist on low-risk stock market investing. If you're interested in getting into investing or even just taking your investing to the next level, I recommend you check out some of the videos in that playlist. If you like the video, make sure you leave it a like, but for now, let's jump into it. And of course, just before we start, I'm not a financial advisor and I'm certainly not your financial advisor, so everything here is just my opinion and for entertainment purposes only. Make sure you do your own research before you buy or sell any businesses on the stock market. So you probably know what Disney is through their Disney movies or something like that, or Disneyland, but you might not know the extent to which, to what their business model extends to. So basically, Disney is this mass multimedia and entertainment conglomerate. So it's a combination of multiple business segments coming together under the brand of Disney. And I'm just going to go through and talk to you a little bit about what the different areas of business that Disney deals with. So Disney's business segments can be broken down into studio and entertainment, which is their primary business. This is their film, their music label, and their theater divisions. Then they have their parks, experiences, and consumer products, which is their theme parks, Disneylands, their consumer products, and other travel-related assets. They then have their media networks, which is their TV properties such as ESPN and the Disney Channel. Then lastly, they have Disney Direct-to-Consumer, which is their digital subscription streaming services, which they will be growing over the next few years. Disney has a market capitalization of $150 billion. They did sales of $55 billion last year and they were able to make $9 billion in profit. In terms of revenue, they are the second biggest mass media and entertainment conglomerate, only second to Comcast. So that leads us into the economic moat. Do we think that Disney has a strong enough moat around its castle in order to fend off competition for the next 10 years? And there's two key arguments that can be made in favor of Disney having a strong economic moat. The first is that it's just one of the biggest and well-known brands in history. I don't think there's anybody out there at the moment who doesn't know what Disney is, who hasn't seen a Disney movie, and who doesn't trust the brand of Disney as being reputable in the marketplace. And the other strong argument that people make as to whether Disney has a strong economic moat is that it's a really well-diversified business. So it's not just concentrated in one area. They have their film, they have their music, they have their theater, which is the core of their business. However, they've been able to diversify into having Disneylands and theme parks. They have a lot of Disney consumer products that sell to consumers. They now own a number of different cable and other sort of channels such as ESPN, Disney Channel, and we'll talk about the Fox acquisition in just a little bit. But as you can see, they're spreading themselves out and they're well diversified in many areas of mass media and entertainment. So even just from that, we could say that it's unlikely that Disney is going to disappear in the next 10 or 20 years. It's probably still going to be a recognized brand to consumers. However, we need to make sure that the hypothesis that we've come up with for this economic moat is backed up in the numbers. So if you've seen my economic moat video, if you haven't, you should check it out. But if you have seen it, you would know that we can form a sort of hypothesis by saying that, yeah, it has a strong brand and it's well diversified. But that's only just a guess. We want to see that, yeah, we think it has a strong economic moat, and then that's actually been backed up by it consistently beating its last year's performance, it consistently growing over time. So next I just want to quickly look at the debt of Disney, and we're basically looking for a debt to equity ratio that is below 0.5, so that means that they have less than half the amount of debt as they have equity in the company, and we're also looking for a current ratio that is above 1.5 to 2, so that they have a lot more current assets than current liabilities. And Disney doesn't really beat any of these, but it's not horrible. Their debt to equity ratio, I believe, is about 1, so they have about the same amount of debt as equity in the company, which means their assets are funded half by debt and half by equity. And if we look at their current ratio, at the moment it's about 0.75. So that means they actually have more current liabilities than they have current assets. And both of those make Disney a little bit more risky. However, they're not overwhelmingly concerning. And it's not like Disney is this new business model that's taking on lots and lots of debt, and that hasn't proven that it's been able to sustain
English, motherfucker, do you speak it?
Sustain itself over the long term. So next, let's look at the ROIC, which is the return on investment capital. And this basically tells us how effective is management at investing our money for us. And what we're looking for is we're looking for above 10 or 15%, and we want to see that from the 5-year to the 1-year average that they're getting better, that they're getting more effective more recently, that they're not getting less effective over time. So if we look at Disney's 5-year ROIC, we can see that they have an ROIC of about 13, which is above our 10%, which is a really good long-term, or at least a 5-year average ROIC. And then if we look at the 1-year ROIC, we can see that it's almost 17%, which is really great for 2 reasons. 1, it's really high, it's above 15%. And 2, it's also above the 5-year average, which means that they're getting more effective over time. So now we're just going to take a look at the 4 key growth numbers to see if they're being effective over the past 10 years at growing revenues, growing sales, growing their free cash flow, and growing their equity. So if we start off by looking at the earnings per share, we can see that they have strong long-term earnings per share. However, this year they weren't able to grow it. And I'm not super concerned about year to year, especially in a business that is as big as Disney. They're going to have years where they're not going to grow. As long as over the long term they're keeping that number above 10% or around 10%, I'm very happy. Now let's look at equity. So there was no equity growth at all over the 10 years. However, it's not declining steeply, at least. It's declining a little bit by 1 or 2%. So that's not a huge concern for me either. One of the biggest reasons why equity isn't growing is because they're paying out a dividend, and the dividends reduce equity. So that doesn't really bother me. And they have a lot of equity in the business, and as long as they continue to hold a lot of equity in the business, I'm happy with that. For free cash flow, long term is really good. It slowed down from 2016 to 2017 because in 2016 the free cash flow included an extra $1.2 billion in cash from deferred taxes, which made 2016's number unusually high. And therefore, when 2017's number was normal and better than the 2015 number, it made it look like it's sloping down, but it's actually not a concern. Over the long term, cash flow growth is very good. And lastly, sales growth. So sales growth is slow, but for such a large business, that's kind of expected. The long-term growth has been consistent, which is important. It's consistently around 4 or 5%. This year it didn't grow at all, and that's probably why earnings didn't grow at all. Because if you don't bring in any more money, then how can you expect to make more money on the bottom line unless you're able to reduce your costs of sales by a lot. So as we can see, over the long term, their growth has been really good. However, recently it's been a little bit of a hiccup. So we kind of wonder, where is their growth going to come from? And now we're just going to have a look at some of the growth prospects of Disney over the next 5 or 10 years. There is currently a proposal for Disney to acquire 21st Century Fox, another huge media business. It will acquire Fox Film, TV studios, and its extensive cable network channels, as well as other assets such as a 30% stake in Hulu and a 75% stake in National Geographic, which is amazing. Disney also plans to launch its own Disney content streaming service, which will compete with the likes of Netflix. This could take market share from Netflix, as Disney owns some of the biggest movies such as Marvel, Lucasfilms, and Pixar, as well as many of its own Disney classics. This, combined with the Fox acquisition, makes Disney a very attractive company for growth over the next 10 years. This service isn't expected to be available until 2019 or 2020, so it's not going to add to the revenue and add to the profits on this year's and probably not even next year's. However, it's nice to know that they're looking to expand into areas that are really hot right now. And the the subscription model that Netflix has with their streaming and that Disney will have with their streaming service is a really effective business model, because it's kind of like that gym membership. So many people have a gym membership, but not that many people go to the gym. And it's because once you sign up, you forget about it, and you've got them hooked, and you've got them giving you money every month, even if they're not really using it. So now let's talk about the valuation. What price can we pay for Disney that would get us really sufficient returns over the next years? And of course, it's first really important to identify what returns we want to get. So I think that a really good return to expect is 15% per year compounded over the years. So every year you're going to earn 15% on your money. So the return that we make is going to be a mix of the stock price appreciating, the stock price going up, and the dividends that we earn. So Disney pays a dividend of 1.7%, and they've been paying a dividend since 82, and they've actually been paying a dividend since earlier before that, but the streak of paying every single year is from 1982, and that's an amazing streak. You don't see that every day. And they've also, in the last 10 years, they've been growing their dividend by 20%. So we're not going to assume that they're going to be able to continue to grow their dividend. However, just to put it into perspective, if they grew their dividend at 20% per year for the next 10 years, in 10 years, they'd be paying a dividend of $10 per share. And even at the high price that Disney is right now, which is $100, if you bought it at $100, they grew the dividend at 20% per year. In 10 years, you'd be getting paid out a 10% dividend every year. So you can see how dividend growth can really help you over the long term. And especially if we pick up Disney shares around the $50 mark, you could be getting paid out a 20% dividend in 10 years' time. But we're just going to assume that they're going to stick to a 1.7% dividend, or actually we're going to round it to 2%. So that means from the stock price appreciation, from the stock price going up, we want to see a 13% return. Then we need to determine what PE ratio we think the business will have in 10 years, and we're just going to take the average, which is 14, and it's below the long-term market average, so I think that's a pretty conservative and reasonable number to put on it. Next is the tricky part. How much do we think Disney is going to grow over the next few years in terms of earnings and equity and that sort of thing? So earnings has been growing at 10% over the long term, so we could use that as our metric. However, we're also going to calculate it for 5% growth, 10% growth, and 15% growth, so that we get a broad spectrum and we can see what our options are, even if it grows as slow as 5%. So growing earnings at 5, 10, and 15% with a future PE ratio of 14 puts our 10-year price for Disney at either $130, $207, or $322 a share. If we then discount that by what return we want, which is our 13% from the stock price appreciation, that gives us a current value for Disney at $38, $61, and $95 per share. So since Disney's stock price is about $100 a share at the moment, you can see that the market thinks that Disney is going to grow about 15% per year. We then need to work out our buy price, and this is half of the current value because we want to allow for a 50% margin of safety. So that means that we will be looking to buy Disney at either $19 a share, $30 a share, or $47 a share. In summary, I would consider buying Disney at a price between $20 and $45. And that's because I think that Disney's growth is probably going to be closer to 5% than it is 15%. I think 15% is way too unrealistic for a business that is already as big as doing $55 billion in sales and $150 billion in market capitalization. So I would expect that in 10 years, Disney's stock price will be sitting around the $130 and $150 mark. So from that, you can sort of work out what price you would be personally willing to pay. However, you've always got to be more conservative than what you're expecting to get. Like, if you want to double your money, and I'm saying that it's going to be $130, you can't buy it at $65, because if you make a mistake, or if I've made a mistake in our valuations, then you're not going to get your double. You're going to get less than that. Disney's stock price is at $100 at the moment, so we'd need to see a considerable drop in price in order to buy into Disney stock and start acquiring a lot more shares. Now, this might seem ridiculous, like how is Disney stock going to drop 50%? Or I don't want to wait for that. But I just want to take you back 10 years, exactly 10 years ago. And I want to go through an example of what could have happened 10 years ago if you were looking at Disney stock and how it can be the same going forward over the next 10 years. So in early 2009, Disney's stock price was around $18. If you'd analyzed the growth of Disney at this time, you would have found that from 1999 to 2008, it grew earnings at a 15% compounded per year. If you'd used that growth rate in the valuation, you would have come up with a buy price of between $16 and $20. And since the price was $18, you would have jumped onto it. So if you'd picked up Disney stock during the global financial crisis at $18 a share, you would have earned a compounded return of about 20% per year. And none of this even includes the dividend that Disney paid over the past 10 years, which has been about 2% consistently. And it was probably a lot more if you were able to pick up the stocks at $18 a share back in 2009. So I'm not telling you this because you missed the boat and you should have bought them 10 years ago. I'm telling you this because if you look at the long-term growth, which it was 15% at the time, if you allow a big 50% margin of safety, then even though they didn't grow at 15% over the next 10 years, which was 2008 until now, they grew at 10%. And because you allowed that 50% margin of safety, you still earned a really, really ridiculous return. So the most important thing is to not overpay for a stock. If we were able to pick up Disney between about $40 a share and it grew at 15%, as we didn't even expect it to, but it grew at 15% over the next 10 years, our 10-year price was $320. You're going from a $40 investment to a $320 investment. That's 8 times your money in 10 years. The point I'm just trying to make here, I guess, is that it's really important to not overpay. And it's really important to be patient and wait for that 50% margin of safety and then buy in. If you're a little bit confused as to how I got to these valuations, I have a video specifically on how you can value a company in my playlist, but I'll also put a card to it on the screen and I'll put links down to it in the description. And if you're interested in learning how to do that, you should check those videos out. So that's all for today. I hope you enjoyed my analysis of the Walt Disney Company. If you did, make sure you leave a like and let me know your thoughts down in the comments. If you haven't already, make sure you subscribe so that you don't miss out on any of the great content that I'll be bringing out in the near future. If you want to see a specific video or a specific analysis, make sure you let me know in the comments or email me or DM me on Twitter, and I'll be happy to make a video with regard to that, as this is a really tight community and I want to show you guys what you want to see, not necessarily just what I have to say. Thanks for watching, guys. I'll see you in the next one.